We're here to know about credit, how to manage the credit, and how to get the credit. So by the time we come out of here, we come out with money. Remember I told you guys, do not walk out of here without a concrete bank relationship manager. You know, remember I've told you I was ahead of SME. So to this time, I'm now on this side of you entrepreneurs. So I'm telling you secrets that will help you score. So what you do here, we've brought them. So during the break time, don't even come talk to me. No. Look for those bankers. They're here. Talk to them. Interview them. This is a choice. So we brought them to you, so you're choosing the best. And then once you've chosen them, work with them. Because trust me, they are ready to give you cash. They are ready. So, but they just need to work with you. So we are going to give you some of those secrets. We don't mind them knowing that we're giving you the secrets because, hey, this is information that is really there. It's nothing new. It's just there. So only that now we are helping you. We are packaging it for you, okay? So what's a credit? What's a loan? We know these are contractual obligation. It is contractual because when I'm coming to you, I'm borrowing, right? And the person who's lending to me is lending me something. Now, one of the things you need to understand is that when the lenders are lending you cash, to them it's really, it's not their money per se. Most of them as banks, they're actually lending you money that has been entrusted to them. So you can imagine they will want to do all the due diligence possible to make sure that this money is paid back, and not just paid back, but paid back at an interest, right? So it's a contract, and someone must pay back and must pay with an interest because that's their business, right? The same way you're in business, they're in business. Who gives this money? We have banks, and some of them are here. That I don't need to explain who they are. There's microfinance banks. We know that these are kind of smaller banks, but indeed just banks still. What happens is that you find differences in the amount of money they can give because any bank has a limit of an amount that they can give. And as we are going on, our training is in 3 parts. So I'll do the first part and the second part, but about at 11 sharp, we'll be going for breaks, some tea breaks, so you can see already the caterers are there. Then after that, I'll finish, and then my colleague Marion will join us. So we also have SACCOs. We all know about SACCOs. SACCOs, people coming together, the institutions, they are regulated. Some of them are called deposit taking, and some are not deposit taking, but under regulation. The banks, we know CBK regulates them. We also have insurance companies. They have devised products to lend into businesses. We have third-party lenders. These are any business that forms itself to lend money. They know where they get their sources of funding, but to lend, those are what we call third-party lenders because they're not deposit taking. Now they're under regulation. CBK is also regulating them. You've heard of Digital Lenders Act. So now they are under regulation by the CBK as well. If fintechs, the same. The digital lenders, they are under regulation by CBK. Chamas, ladies, I know these are your favorite, chamas, and they really help, because you understand yourself without the chama. There are so many things that you do with the chama that you will not be able to do by yourself. They kind of force you to save. For me, I have my comments about the chama, but for the ladies, it's nothing negative about the chamas, but so when you look at interest, those monies, you're not going to get interest, but it actually forces you to do what? To save, right? As you're contributing and waiting for a whole 6 months before you get money in bulk, it has helped you. Financially, not necessarily in the sense that you're actually losing money because of time value of money, but it helps you achieve the savings. So it's good because you still borrow from them, right? Then we have family and friends. As sources of business, we know that this is big in Kenya. It doesn't have to be big like that. In the other developed countries like America, people are always ready to lend, right? So, but as our culture grows, we'll get to those levels too, and that's why we're here today. And then we also have Shylocks. These are just unregulated lenders out there. And so we know sometimes the interest rates are really up there. But sometimes because, we are businessmen, we're thinking, okay, we need to do a particular deal. I need this particular amount of money. If I do this, I'll make this amount of money. So we find ourselves having to borrow from these unregulated lenders. But today, we're here to make you Mrembo Imara. Very beautiful and attractive insofar as banks are concerned. That's our objective. So you find yourself not needing to go to those Shylocks. And then just before I move to the next slide, I want us to answer some two questions. Is loan good or bad? Is borrowing good or bad, right? So think about that, because the answers are normally very clear. Because you can do a loan, you can buy stock, right? If I'm running a trading business, I can only grow my business as much as the stock I have, right? So if I have a lot of stock, then I'll sell more. So in other words, it's good. Yeah, so in other words, it's good for you, right? And then my business could be related to my area that I'm serving. So the more space I have, the more I can be able to produce. Say if I'm manufacturing, for example, and I'm only hiring people to maybe stitch clothes or do something. More space, more money. So I might need to go to the bank so that I'm able to get that access, right? Staff as well, I've mentioned that. So you might be doing a very good job, but you don't have the money to increase your staff for now. Because one of the things that we know about our business environs in Kenya is that we have a lot of credit sales, right? And I'm sure SMEs, we know that pressure of credit sales. Because we find ourselves needing to buy commodities or products in cash, and then to sell to be paid after a while, right? So what does that cause? It causes a credit crunch crisis. It's really a crunch crisis, especially you business women. You know that very well, because I need to trade, but I don't have the resources. Yet, I have so many people who have already supplied. It's not that I'm not working. I'm supplying, I'm selling, but they have just not paid me. So then we sometimes need banks or lenders to come and bridge that gap so that our business machine can continue running, right? It could be, I'm in manufacturing and I want to increase my equipment capacity, because if I'm in manufacturing, if I have an equipment that is more efficient, in other words, its output is more, then alas, I'm making more money. So it's okay to borrow, right? It's okay to borrow so that I can be able to get that. So loans are good, borrowing is good. And it could be that I am paying so much money on transport, or my trucks are inefficient, my transporter is delaying me, I manufacture my commodities, whatever it is I'm doing in a timely order, but the delivery is just a problem. So I'm losing my large companies, whether it's supermarkets, wherever I need to deliver, I'm losing because of my inefficient transport services that I am getting from out. So what do? Better run to the bank, get an asset finance, and then control my transport. So it's good. It helps the business. Now, the same thing, borrowing can be bad in the sense that if you use the money for the wrong purposes. Say, for example, I've gone to the banker and I've said I need a bridging finance. I have this crisis that we've talked about, the crunch. Yeah? I need some cash so that I can buy stock, supply, and the banker can see that indeed I have good history. I supply. But then now when the money immediately hits you, remember, I was buying a plot in Kitengela. Yeah? And then I take the money there. What have you done to that business? You have messed it up completely, because number one, the lifeline, which was your banker, now will not give you any more lifelines. They won't. So, and as we go on, those are some of the things that we'll be learning today as we go. And we'll be telling you priorities, especially as business and in relation to borrowing. There is a relationship that we need to have with those bankers of ours and lenders that is really critical to help our businesses grow, right? So we've heard about borrowing and loaning, and it's good. So what are the number of loans? Now, this by no means this list is not extensive enough. It doesn't capture maybe even 50% of the loans or products out there. But I'm just giving you some of the products so that you can start getting to understand them. And even the terminologies that I've used in some of this that we've used are very broad, but it helps. So we have long-term loans. A long-term loan is any loan that you're given with the bank that is more than 1 year. That's a long-term loan. So again, it could have its own minor sub-products depending on the lender, depending on whoever is lending. You remember, I'm not representing any bank here. I am just an expert insofar as lending is concerned, and so I'm giving you a very broad picture. Then we have short-term loans. Short-term loans, again, is any loan that is less than 1 year. So that it could be an overdraft. Again, there are so many subsets in there, but just understand that it's time. Now, why are those two very good, important to distinguish? One of the reasons is this. if I am getting money, remember we talked about stock finance, we talked about bridging a solution gap. If I'm taking any of such kind of a loan, most of the times it's good for you to approach the bank knowing that it'll be easier for them to give you a short-term loan as compared to a long-term loan to bridge a stock position that is, say, contractual, or it's one customer who owes you money and there's an invoice you've already performed. Remember, by the time you're raising an invoice, you've done what? You've already performed, right? You're only waiting for payment. So when you go to the banker and say, hey, I'm looking for a facility. Now, if you structure it as a long-term facility in your mind or in your request, then they will not give you the funding. Because when they look at it, they're like, no. This is just, you just have a time gap here. So maybe it's a contract I have supplied to a particular business, and I'm now waiting for payment. So it is in his interest as a bank to then just structure it as such, short-term in its nature. So now we are beginning to understand why sometimes we get approvals and declines in loan applications. So it's in other words, it's a question of the type of the loan that you are getting into. So, because the banker is trying to understand, remember, when you're getting into a banker or a lender relationship, this person is trying to understand you. And is trying to investigate to see, are you going to pay this loan? What are your intentions? What are your purposes? So you can come and say, I want a long-term loan to pay you in 3 years. Yet, when the banker looks at your application, he's saying this is a short-term in nature. So you see, already now he starts disqualifying you because there are some subtle questions that they will never ask you, but they will say, no, this one was not intending to pay. But you have just innocently misunderstood, right? And so that's why today we are here to understand these various types of facilities. And also, yes? Yes, Mike. Oh, sorry, I think I have one.
My question. Okay. Who is supposed to, because when we began the conversation, you started by saying a concrete customer relations manager for your account.
Yes.
Who then is supposed to advise you? Is it, say, we are entrepreneurs. Yes. Is it somebody who is dealing with entrepreneur development, or is it your customer relationship manager who is supposed to advise you on what kind of a loan to actually ask for and the terms to, like, say, the terms that are in application for that particular facility?
Good. All right, that's a fantastic question. My answer to that is really your banker relationship manager. You're good, and I have to say, use the word good relationship manager, because a good relationship manager is supposed to extract that information from you as a business and advise you. But you see, now that's you throwing your fate onto someone else who you're hoping that is good. And my former colleague can tell you, not all bankers, relationship managers are good. Sometimes they're even very fresh, straight out of school. And they're there, and you've gone there, you have been pushing your business for so many years, and you come there and you sit down. And unfortunately, they might have a very experienced, like high above the hierarchy, there will be some good bankers out there. But your touch point is you're not going to see the head of the department, right? You've gone to the branch, there's someone is seated there, and is not well trained, well versed. So why we're here today is just to start also helping you as business owners to kind of now have these decision-making tools on you. So that by the time you're going there, you're telling this banker, hey, this is what I'm looking for. And that's why I say today, make sure you don't walk out of here without a relationship manager. You might be having a relationship manager, but they are here, good ones. Like they have passed the empirical research study that we have done and have been able to be outstanding insofar as their willingness to help you. So again, that's one of the things we resolve today. Let's come out of here with a good RM, get their contacts, we move forward. If you allow me, I can proceed. All right, cool. So the other one is overdraft. Now, what is an overdraft? An overdraft is when the bank allows you to overdraw. So your balance to below zero. So normally you have whatever you put in your account, that's your money. But the moment you go under, as you've taken more, you're now overdrawing, you're on the red, right? So, and you can never do that. The system, any bank system will never allow until you have authorization and the limit is marked onto that account. Now, but before they give you that authorization, they'll have seen why do you need an overdraft. Now, most of the times as entrepreneurs, we always, want to go for the OD. Overdraft, OD is a short for overdraft. So most of the time we want to go for the OD because it's a quick access of money and putting in. But if you use overdraft cash to do a long-term project, like say purchase a motor vehicle or refurbish, something small like refurbish your shop, then you're messing yourself up. Because what's going to happen, that overdraft, bankers say, is going to be called a stack overdraft, or it's going to become hardcore. Hardcore means it is not swinging. So an overdraft in its own nature is supposed to swing, completely swing. Like if a banker gives me an overdraft of 100,000, then in the month I must have at one point gotten into credit and then back up there to the overdraft. Even if it's within the day, even if I was in the beginning of the day I was at a negative 100, but then I went up to to credit of 2,000 shillings and then went back down there, it's still fine. In other words, overdrafts are just primarily to solve that crisis we talked about, the credit. Your business has sold a lot in credits and is waiting for money. So the banker will allow us to overdraw so that after a while, the money will come, right? It will come. So keep swinging it. It doesn't mean that you must be on credit, no. But the word is swinging. Keep using it. So when you're approaching the bank and you're insisting on an OD, and yet it's a long-term nature, again, you'll get a decline. So remember, today we are looking at directions here. That by the time we come out of here, whatever application we put to the bank, it's an approved application. That will be the success of us as a project, right? So stock loans, again, just as the name says, it's very specific to purchase of the stock. Most of the times the bankers will give you money but pay directly to whoever your supplier is. So the goods come. And so you're able to sell and then cover or repay. Stock loans, again, are short-term in nature. Overdrafts, they are one-year contracts, so they're also short-term in nature. Then there's also what we call accounts receivable financing, or mostly known as invoice discounting. So I have supplied, maybe it's goods or services, I have an invoice. Then what do I need on this invoice? I just need some money out of this invoice. Again, we talked about that because it's very prevalent in our market, this issue of selling in credit. And sometimes it's you businessmen here who make it a prevailing situation in our country. Because if all of you business suppliers say, we are not supplying anything in credit, do you know that thing will disappear? Because the thing is, we go to the large corporates and we tell them, hey, me, I will supply, and then you will pay me after 30 days. Your competitor comes quickly and says, hey, I will supply, but you will pay me after 60 days. Me as a corporate, which one will I pick? 60 days, because you're helping me avoid overdrawing my account. Because as a corporate, I need to access an overdraft or whatever it is to pay you. Now you're making me stay with money. I'll sell your commodities, maybe even the second day. So I have money. And cash is king. Cash is king. So the day businesses we agree, then that practice will leave. But as at now, it's a major, major issue. And so that's why a lot of financiers have come up with this product. But what's been happening with the bank side, they are now insisting on collateral before they give you invoice discounting. Earlier on, they used to do it before. But remember, there are things that are changing insofar as the financing or reporting is concerned. Now I think banks are using IFRS 9, which says anything that is not secured already has to be 100% provided for. So there's such complications happening, and that's why even in this room today, we just don't have banks. We also have digital lenders. So if your product is coming on that aspect, then they are here. You can talk with them. So they might charge you higher, but they're here. Remember what we said, that this is a linkage event. So my business might not be sorted out by the banks, and I'm hoping the banks will sort you out. But then we also have digital lenders here who will sort you out. So it just depends, right? So moving on, we also have importer finance facilities. Like I mentioned, different banks call them differently, right? So these are just, what you need to do is get a relationship manager here who understands what you're importing, and then importantly, the trade terms that you have there. Your trade terms with whoever is you're supplying you, whoever now is exporting from their country now for you to import. Because some suppliers, international suppliers, give you letters of credit, some international suppliers would give you even advance. They say, okay, you know what, just you take, pay me later. So it just depends. So your bankers should be able to structure a facility based on that. Now, you see mortgages there, yet we are talking about business here. So you could be a business that wants to do what? Purchase an office space because it makes sense for you. But it can only be on very special circumstances when you have to do that as a business, because you need to do a lot of calculations so that you're saying, okay, how's my balance sheet size like? Do I really need to add an office in this? Is it giving me value? Am I in the business of owning space? Or can I just then rent and then make my money out of it, right? So it needs to be very, very well calculated. And certainly not your home mortgage in your business books, right? We're together? Okay, good. And I want you, as you're going on, yes? Oh, sorry. So if she just asked why. Yes.
Let me just throw this.
Yes.
Why not consider a home mortgage from your business? This is your source of income.
Yes.
And you're the one building this brand or this business. Maybe you can ride on the fact that you can get a mortgage from the business.
Okay. All right. Okay, so there are so many ways I can answer that question, but I'll just try and make it as simple as possible. So by the time the business is paying for that mortgage of your house that you're staying, have you added it as a benefit onto your salary? In other words, is in your policy as a business the business buying a home for the owner as part of the benefit for the founder? Because everything we do in your business, let's just talk here because we are business people here. So your business is your business, yes, but then it's under regulations. Like one of them is the Kenya Revenue Authority. So the Kenya Revenue Authority understands salary perfectly well, and that's why there'll be pay-as-you-earn tax. It understands benefits that you accrue from the business, and those benefits will also be done what? Taxed. So the moment you purchase your home and the business pays, then that title or whatever it is should be under the name of the business, so that in your policy there you've put one of the benefits of the owner of the business or CEO is that the business will buy a house, so that the taxman now knows how to tax it. Now, if it's not like in that space yet, then the only best way to do is then you earn your salary, use your salary, approach the bankers with your salary, and then let them sort you out a mortgage against your salary. That way, as you're paying from your salary, your salary is already taxed, right? As pay as you earn. And then if you're a first-time homeowner, then there's a benefit you get on first home, carrier tax benefit, and so far as they pay, that one again your accountant can calculate for you. So the only mortgage, and is it answering your question? Yeah. So the only mortgages that we need to see on your business book is an office mortgage or a factory. It's a loan that the business gives you. The bank gives you to purchase. Yes. No, it's okay for the recording.
Oh, for the recording. Okay.
Yeah.
So you're saying we should be able to take mortgages for offices and stuff, right? But reality, I'm not pointing fingers at anyone. Reality is we don't pay ourselves as small business people.
Yeah.
So if I decide that my business will be paying my home mortgage because that's the way for the business to pay me back, would that still be okay?
Thank you for that question. So, like I'm saying, you will definitely need to work with your auditor and tax auditor, so that now the tax auditor can be able to give you that advice. But what I'll tell you, it's best that you call that payment, because it's going to be a payment, right? First of all, these bankers here, they're not saying, but they will hardly give you the loan to do that. They will hardly give you the loan to do that, because one of the things that they will be looking at is, okay, you're saying your business will pay for your home, Then they will ask you, okay, let's see your policies, your employment policies. As a business owner, what's the employment policy? Because again, you get yourself into a tax issue. It's like you are literally pulling money from the business without paying taxes. And I'll explain. If I'm buying a house and the business pays for the mortgage, what has happened to the business? There's money coming out. Now, what's the invoice? Because remember, all the payments that you do from your business must have an invoice, right? So what's the invoice to the business? You get? So when the taxman comes, it's already an issue. So that's why we say it's best that you work at salary, which is going to be taxed as pay as you want, then let now that be a separate arrangement for your home. Because what will happen then, the worst case scenarios is what will happen. The taxman, when they're auditing your business, they'll say, no, here, this money that has been paying this, because again, remember, one of the things that and this is a very strong point for you guys to understand, any interest expense that you pay with the bank, that is an expense that is allowable by the taxman. In other words, if I've made so much profit, like my gross profit before now the expenses, if I took money to get from the banks to buy stock, for example, and the banks charged me a processing fee and an interest, I can literally take that fee and load it up there to reduce my net profit. And my taxes will be against the net profit. So if you do the personal home, then you take those expenses for the interest that has been charged by the bank on your personal home. See, that's a complication already, because the taxman will say you're literally taking money from the business without accounting for it. Because that interest, if it appears there, then there's a challenge. Unless there's a policy, very strong policy in your business that says this is a benefit. And so the taxman now will tax you as a benefit. You get what I'm saying? I think I can move on. All right, no worries.
I think the assumptions you're making are that we are in very structured, owned businesses.
Yes.
Which is a very, very wrong assumption.
That's true.
We don't know about all payments must have invoices. My business is, you're calling, it's urgent, let me pay, I pay. If it's the taxman you're talking about, the audits, the what, those are not the main pressing needs or pressures to me as the owner of business. My worry is, it's moving on. So there lies another problem that maybe you'll give us a solution, as indicated earlier, on how we can make our businesses extremely structured, or policies, like I'm even thinking, policy to buy the CEO or the owner a home. It is in my head. That is where I'm working, you get? So, yeah.
Okay. No, the truth be told, that's really one of the, and you'll see in our part 2 of our training, you'll be seeing that that's what we're trying to help you do. We're trying to help you organize your business. We're trying to help you love recording. You know the way how you have those old cash books? It's so good to have those old cash books. You remember those old shopkeepers when you were growing up, umechukua, then they write. These days they don't write, right? But those days, they're writing, recording. But these days things have come up, and we literally have partners here who will help you with that organizing. It's called digitizing your business. So let me just jump into that point. You'll see it again. But this simple apps, some of them are literally free, of charge. When you make a sale, just record the sale on the app. When you make a payment, record the payment on the app. And you know what that app does? Is that it creates for you a balance sheet on the other side. It creates to you what's the assets for your business, what the liabilities are. Now, here's the thing. One of the things about you becoming Mrembo Imara, you remember these bankers are here and they're listening. In fact, you see that one of the reasons why you don't get the loan approved is because the first things they'll ask you, give me this documentation. It normally looks like a very long, boring request, right? I want your balance sheet. And you'll see them. I want you these documents, profit and loss. Yeah, so by the time they're sending you that, it's so much information and it's so boring. But they just want to simply understand your business. Are you making money? So when you start digitizing your business, in other words, anytime I've put money into the business as capital, let me record it as capital. Anytime that I have spent any money, even if drawings are allowed, because if I put capital into a business, that money was already taxed, right? My capital that I put in the business was already taxed. So the taxman allows me to draw that money out as the business grows. It's called drawings. But once you finish whatever capital you put in there, you cannot do any drawings. The only amount of money you can get from the business is what? Dividends through the profits that you made. So, as business owners, those are the things we're looking at, structuring our businesses and putting them into records, because that's what helps us get this cash. But we will also look at that when we get to part 2. So one of the points that I've just said here, understand that any interest expense that you incur as a business on paying these loans is allowable. Is allowable, meaning the auditor can load it up there and then you pay less tax. So that's one of the reasons why big businesses borrow. Like I like to use this example. If a Safaricom CFO today stood up and said, hey, you know what? As the chief finance officer of this large company called Safaricom, I have decided that there will be no more borrowing by this business. That guy will lose his job tomorrow. There's something called leveraging in finance. He must leverage that business. No matter how much money he has, no matter how much money you have as a business that you've generated, for your business to be, balance sheet to become most efficient, you must do what? You must leverage. Leveraging is just adding debt into your balance sheet. Because the moment you add debt into your balance sheet, you're making your balance sheet more efficient. You're bringing yourselves to use money that you have not yet sweated to generate, but to generate income with it. And as you're generating income with it, there are some expenses that you're paying interest that will help you pay less tax. So if Safaricom, for example, decides today to use all the money it's generated and never pay the interest expense, then you will see the efficiency. When anybody who calculates efficiency on that business will say it's not an efficient business. Right? So that's why we are saying loans are good. And for owners, sometimes we do not want these loans, but we need them for them to help us grow our business. So those are the things that we need to align and plan. LPO financing is just as simple as it said. You have a local purchase order or a local service order, you have no money to service it. So there are institutions that will give you money against it. But most institutions will always ask for security. And the reason why they'll ask for security is because there's a risk of performance. I can give you the money to perform an LPO, and then what do? You don't perform. So what happens? My money that I lent you is lost. So the banks are smarter than that. So you need to get a collateral so that if you don't perform, no problem. Then we'll come for your collateral. Contract financing is almost like, contract financing is pretty much like LPO, but mostly on services. Could be just depending. Other businesses don't have local purchase orders, but they have contracts. Bonds, let me not deliver so much on bonds, but bonds is just a secured debt, secured by the assets of the business. Debt factoring, we talked about invoice discounting. So it's simple. It's like you're factoring. Factoring is you're discounting on an invoice to get some cash. Asset finance is one of the fastest loans that you can be given by a bank because it's a vehicle, it's a machine, it self-secures itself, and you've shown that indeed that machine or asset or vehicle will generate you income. Requirements. I'm coming to the close of this first part. Let's just understand. So let's look at these requirements keenly, business women. And sometimes we are not Mrembo Imara, we are not attractive to the banks because we don't have this. Or we have them, but we've not strengthened them. Now, ID, we all have an ID, right? So this is just the bank to know who you are, because my ID is me. If you want to find me wherever, the government only recognizes me with ID or passport. So this is for KYC. They need to know you. The KRA PIN as well. We've talked about taxman. We're all here. We're all citizens. And we are all responsible towards building this nation. And we all have our part to play. And our part to play is always contributing towards the national building through taxes. And any business you start has an interest to the government through the KRA. So it's critical for you to have that as well. Sometimes you may be very dormant with your PIN, or you had a rent collection, you collected somewhere rental income, and you didn't pay the tax, the 10% tax, right? So now your PIN has a problem. So you come back to the bankers will just not give you money because your PIN is blocked. And so you see there's a relation between your personal, because my rental collection has nothing to do with my business, but it affects my business because now my PIN is blocked. They won't give you money. And by the way, they search it to see if your PIN is active. So, and then maybe you did not file your returns for how many years. So you need to be making sure that you're filing your returns, even if it's the nil returns because you are not in business, or, or you didn't make money. Just make sure that your returns are active so that your PIN, and this is both business PIN and your personal PIN, make sure that they're all active. Now, if you're in business and you do not have a personal PIN, just know Mr. Banker again and the other lenders will not give you money because they need to attach it. The business registration certificate issue. We have many business owners who are running fantastic businesses, but in their own name. Do you believe they're there? And some of them are also here probably because you're running a very good business in your own name and you're happy. But when it comes to expansion or moving to the next level, you will get stuck. You will not be Mrembo because the banker wants to know if today you're not here because this is the normal of life, will this business be going on? They want to know, are you formally registered? Because when I'm running my own business with my own names, so am I even paying taxes? Am I paying county licenses? So those are the things that we need to do. So with these days, you can be able to do what is called, with the e-citizen, register a sole proprietor at 1,000 shillings. So this can be one of the first levels to start your business. Just register, incorporate it, have a formal, then quickly go to the bank, and they will open you a particular name, trading as. They'll write your name, your personal names, trading as, now the name that is in the business registration certificate. But the PIN for that particular one will always be your personal PIN, right? So it's very simple. And that's normally under the Business Act, because sometimes you can be two people, then that's a partnership. So you need to have a partnership act. So it's important to think about this, because we're trying to become Mrembo Imara here. Think about scaling your business to the next levels. Let's formally put them together. Now, then we have what we call the limited liability companies. Now, these ones are normally more complex because of the acts that support them. Even the law recognizes that business as a person or as an entity. You're just entrusted. You're a director, you're the living representative of that entity called your limited liability company. Most companies, like the large corporates, want to work with limited liability companies just simply because of the fact, as the name says, limited liability. So the liability only goes to the extent of that business. I need you to sit with your lawyer for him or her to further delve that much into you. But one of the things about getting Mrembo Imara here, becoming Mrembo Imara, is that you need to formalize your business for you to be able to access cash nicely from the banks. They will always take your photo. Again, know your KYC. Now, bank statements. Let's spend some time on this bank statement here. Now, if I am running a business, and this business is trading, maybe I buy cash the next day. Say I'm selling goods worth, let's make it simple, 10,000 shillings a day. And my profit from the 10,000 is 2,000 shillings at the end of the day. And I still need another 8,000 the following day to do what? To buy stock, right? So most business people would decide, let me only bank 2,000. But by the time now you're going to see the bankers, when they run that statement, they're seeing 2,000 times 30. So that's how much? 60,000. But the truth is that that business moved 300,000 shillings. Yeah, because you're making 10,000 every day, right? And I'm just assuming that you're not even increasing. 10,000. So we need to grasp that aspect of making our bankings regularly. Let's put our money in the banks. There's always, obviously, the thing of people say, oh, there's a KRA, there's taxman. Hey, when is even KRA going to start looking for you when there's all these businesses out here, right? Let's think about ourselves now. We need to grow. So the more you bank, right? The more you bank, the more these bankers are understanding your business better. So if, like for me, I'll tell you, and the clear-cut definition of a good overdraft limit for someone is like 100% banking. That's the maximum OD you can get. For example, and I'm selling maybe on credit. So the bank can literally give me an overdraft of 300,000 shillings if I'm banking 300,000 shillings monthly. So that makes sense, right? Even the bankers in the house will tell you. But now, if you've only been banking the 2,000 and then they look at it and say 60,000, then they'll say, no, the maximum you qualify to is 60,000. Yet it's supposed to be 300,000. So what are we saying? We are talking about actively using those statements because they will always look at them. These days also banks look at M-Pesa statements. Transact. Make sure that you have history because and as we go along, you'll come to understand that our business machine or what is fueling our businesses to grow is funding. Because we said cash is king. Now, if it's funding, then what do we need to do to make sure that we access these funds? See, that's the agenda of today. And so one of them is that banking. And then there's the applicable licenses. You might go to the bank, you have all that, but you do not have your county license because you're in a place where the county guys never come. Now, you'll be disqualified for a loan. Just pay for that county license and then up it on your product pricing. Remember, you're in business. So whatever you're expending, it must come back insofar as profit is concerned. So that's good practices, and it helps you become Mrembo Imara. So that, yes. Sorry.
I run an events management business.
Yes.
At no one point am I expecting walk-ins. Someone was just passing by looking for an event shop. So what does that mean? I do not have a shop. I don't have a space. But I have a business address that I use. So when I'm being asked for licenses, what license should I give?
Okay.
Yeah.
Good. So where you have the business address, now, you know the county government has like, there's a list, it's normally like 100 of businesses. So you'll find it there. It's always there. Now, as of the requiring the license, I say, yes, you need it, even if it's in a place where nobody will see you, because now when you go to the bankers, they will ask for it. Because remember them, they're document-based. They're not even physical-based. They will probably never come to your office, but most good RMs will always come to where you are before they give you cash. In fact, these days, most RMs are required to take a picture in front of the business shop to show that they were there. Yeah, you see, they're even advancing. Pin location plus. So it's important to have that. Because remember, in Mrembo Imara, we want to become more attractive. So yes, it might never be seen by any county official. But now when it comes to accessing the funding, they will need it. So it's always good, advisable. All right, let me just say my last slide here before we go to for break. Continuation, they need financial statements as management and audited accounts. Now, this is not a complex thing. We talked today about digitization, right? So someone will come here and talk about digitization, and they will tell us that in this free app that you have, literally, any sale that you make, just write it there. Write the free app, put it there, put your sales, put expenses, and then it's calculating all that at the back. It's doing your balance sheet, it's doing your P&L. When the lenders ask you for them, just print. It may not be audited because you're still a small business, maybe you're still growing, but they will use it. And one of the most important things, by the way, the financial statements are not necessarily even good for the banks. The most important person is yourself. You need to know, am I making money? Because if I'm not making money, then why the efforts? Why are you leaving your house to go to this place you're selling things or do these services? Because it's not easy. It's work. Pushing business out there is work. So that quickly tells you, one, am I making money? Or two, am I making enough money? Do I need to increase my pricing or do I need to reduce my costs? We'll talk about that in our next session. The other one is projected cash flows. In the next session, I'll have a detailed projected cash flow for you to look at, because when you go to the lenders, if you ask for money X, they want to know, what is the impact of this money on my business, on your business? They will never give you money if the impact is a negative impact. And by the way, it's possible to tell if the impact will be negative. Because they just look at it, okay, fine. What's the impact? Okay, they calculate with you. So spend time. Spend time for you yourself as a business owner. Before you go get that cash, spend time to literally understand, what is the amount of money I need? Sometimes you might ask for so much more that you don't need. You pay interest, you pay processing fee. You know, there are those fees that you pay based on the amount you take. So you might save yourself those processing fees by taking maybe a small amount and then gradually increase. And by the way, the bankers are always happy to give you a smaller amount and then increase it as the time goes. They have no challenge with that. And you actually might improve your chances of getting an approval. So, but we'll look at that at part 2. The age debtors, age creditors, the thing we're talking about, people have your money out there. Aging just means for how long? Is it between 0 to 30, they've stayed with your money for that long, or they've stayed with it 31 to 60 days, or 61 to 90, or above 120? And so, try very hard that people don't stay with your money for more than 60 days. Because if all those guys paid you cash, then you don't need the bankers. 2, if they pay you in excess of the 120 days, then the bankers will say, you have an issue with your collections. You do not know how to collect money. Yes, you are good business, you have good customers, but hey, you can't collect. So if I give you my money, it will be swallowed by those guys who you're not collecting from. You get? Yes. Sorry.
On the debt collection, I think the bankers should consider people like county business,
Yes.
doing business with the county,
Yes.
and the government. They
Yes.
don't honor the 30 or 60 or 90 days
Yes.
credit period.
Absolutely true. I like that. And that's, truth be told. And even you, whenever you're dealing with them, you must price them to that extent. Because they're going to make you borrow for a longer time. So you can't sell them the same way you sell someone who's, I hope that's what you do, right? You have to increase it up there. And true, the banks, that's a passionate appeal from you and to the bankers who are here, that you need to honor and see when people are dealing with counties, they are extending there's extended times. But again, that's why you'll find most of these bankers again refuse to deal with county business because of the uncertainties. Because remember again, when they're lending you the money, it's not their money. It's the public money, so they really are very cautious on that. But that's a good point. Understand your businesses so that you can know how to price them. So if you have businesses that they're staying long to pay you, the price must be higher because you're borrowing. You're going to do all that before you get your money. And then the ones who are paying you cash, let them enjoy the service. Memorandum and articles, these are rules and laws that govern your limited liability company. So they'll want to see that so they can see, can one director borrow? Or when they are signing their loan contract, 2 directors must sign. There are things like those that are normally hidden there. In the older times, we had people who would craft that articles to say 2 directors must sign for a loan. The bank did not check that, so 1 director signed for the loan. Guess what? When they don't pay, you can't take them to court because the directors stand and they say, but these guys gave us a loan ultra vires, the legal terms. Yeah, it was not contrary to our memorandum and articles, and that bank loses the money. So they become smarter by the day, so they will ask for that. Annual returns. If you're a limited liability companies, this is that thing you do with the Attorney General every year that most companies don't do. It's about, I think the fees varies, but maybe about 4,000 there, depending on which lawyer you're using, to renew your business. Because remember, our business has a life. A limited liability company is an individual. So if you don't renew, what happens? At the AGs, they might say it's dead. It's a diseased business. Yet you're doing huge company contracts. Whenever now you get into conflict, you have to go to court. The other party says, but they're not even in the AGs. You lose your money. You get what I'm saying? Copy of collateral, like we said, a lot of all those loans that we talked about will be asking for security. But then again, there are those that don't ask for security. So for you, it's just to work with your RM and tell them, this is my space. This is where I am. This is the collateral I have. What can I access? I don't have collateral. What products do you have? Like that. And then the company profile is always good too. Because remember, These RMs don't have the time to come so much and spend time with what you do. You're the one who understands what you do. So take time to write a very good profile about yourself that markets you. So by the time you're touching it on your loan application documents, it does what? It sails through.